management accounting? Define what is management accounting and explain the difference between management accounting and financial accounting. Now, management accounting is the sourcing, analysis, communication, and use of decision relevant financial and non-financial information to generate and preserve value for an organization. Now, this is basically mostly used by managers to plan and control of an organization. Yeah. It's a process of identification, measurement, accumulation, analysis, preparation, and communication, leading to a mental decision.
Define what is management accounting and explain the difference between management accounting and financial accounting. Now, management accounting is the sourcing, analysis, communication, and use of decision relevant financial or non-financial information to generate the present value for an organization, basically uses by manager. Now, it's also in the process of identification, measurement, accumulations, analysis, preparations, and the communications leading to the managerial decisions. Now, there is two difference between financial accounting and management accounting. Now, management accounting is normally focused. Okay, it's focused more on the internal uses of information, mostly for the managers to use before making a decision. Now, financial accounting, however, is used for external. Okay, this is outside. Okay, so financial accounting information that's produced for lenders, bondholders, people, or organization the firm owes money, as well as shareholder, most of which is external party and is not the company. Now, this is on the user part. Now, we're also looking at the second thing, which is timing. Now, in terms of financial accounting, focus more on the uses of historic figures. Okay, historic figures in the past. It's more to the past. What happens in the past, they accumulate and they come out with the report. Whereby managerial accounting focus more on futures like budgeting for the year end, and all those kind of things. Okay, now we'll also look at proven information. Now, the financial accounting uses objectivity and sources document in order to get their data. Okay, they look back at the traces of the document, previous documents. Now, auditors uses the source document to find data to support the transaction that they are auditing, while the financial accounting is solely emphasized on satisfying the management need, whereby as a manager they need to run their business, so they can run it however they want with the information they get. Okay, now we're also looking at the reporting focus part. Yeah, now financial accounting primarily focus on company's report, meaning that the parents company and subsidiary are all in one report. Whereas management accounting is more of a segmentation report, meaning region, districts, departments, stores, product line, whereby they can even actually have different districts in different area, and they can use this to give them a separate balance sheet and whatnot. Yeah, and of course, last but not least, the most important thing is, okay, financial accounting have to follow the GAAP or FRIS and prescribed format. Managerial accounting do not have to follow outside rules. Financial accounting is mandatory for external report for the Security Commission, but managerial accounting is not mandatory. Okay, now there's a standard to follow, which means the manager does not have to follow any rules. He's pleased to use any style he wants and prepare his report.
Define and explain what's break-even point using a graph. Now, break-even point is the point where the total cost equals the total revenue, with the organization neither making any money or suffer any losses. Now, most of the time, most of the organizations, they will know how much of units they need to sell in order to make a profit, because everybody wants to make a profit when they do the business. And when you're at the break-even, you either make or you don't make. You're just stuck in the middle. Now, that is not something that an organization wants. Now, by using the BEP in short form, we can calculate how much product we need to sell in order to make a profit. From the graph below, okay, we can see, alright, there's two graphs here. Now, this we can see that in order to get the break-even point here, your company will have to sell 20 units at $400. Okay, that is how you get to the break-even point. Now, there's a few factors that you need to take in the break-even point. Okay, for example, if you look at this, we have the fixed cost. Alright, now with the fixed cost, we have the variable cost. Now, variable costs are those that respond directly and proportionately to changes in activity level or volume, such as raw material, hourly production, wages, sales commission, inventory, packaging, supply, shipping, and so forth. Okay, and of course, then we have the fixed cost. Now, fixed cost is something that we can't change, no matter whether We sell or we don't sell, this is the amount we have to pay every month. And this is, for example, like depreciation, insurance, interest, expenses, property taxes, rent, salary, and whatnot. Yeah. Okay. So that's the meaning. Now, of course, when we look at the graph here, now we're talking about profit. Now, profit occurs when actual volume is higher than the break-even volume, okay, which is above here, green. Now you see the rate is loss. Anything if they sell zero or they don't produce anything, they'll be at a loss. And anything in the gray area, sorry, in the area on top will be the profit area. Okay. For example, if we were to raise the price up to 600, okay, 600 without raising the unit, automatically the company will be making a profit. Now this is just a simple guideline of an explanation and break-even point using graph. Show the difference between FIFO, LIFO, and weighted average cost method. Now, assume you own a store and you're selling a chair for $5 each. If the sale price of a chair, let's say our production cost of the chair is below, okay, $1 January 1 purchase, January 6 at $2 purchase of one unit, and January 29 at $3. Now issue sold at $5. Now let's assume that we sell three chairs. Now three chairs to the store for $5 each. Okay. Now we have one customer who wants to buy the first chair, which is the purchase at January 1st, which is at $1 per piece. Now this means if we sell the first shirt, okay, or check, right? What we'll have is the revenue will be at 5, goods sold will be at $1, and gross profit will be at $4. Now, this method is called specific identification because we can identify which t-shirt we sold to the customer. Okay, because there's only 3 t-shirts and there's one customer. This, however, may not be doable in our production is so high as we sell thousands of units. So that we want to be more efficient and we write an assumption. Now that is where there is a thing called FIFO, LIFO, and weighted average comes in. Now this will make it easy. First in, first out. The production that we buy first are the products to be sold first. Now if you look here, assume that the customer picked the second shirt and paid 5 for it, which is bought purchased at $2. Okay, revenue 5, we sold it at 5, still the same. Cost of goods is no longer 2 because under FIFO, first price is at $1. So we're looking at $1. Now the total gross profit that we will get here will be at $4. Okay, next we're talking about LIFO, last in first out. The product that came in last is sold first. Now if you look here at the date, purchase, issue, and sold, right? Price goes 1, 2, 3 in the price, and the issue sold same. Assuming now the same customer pick up the 2 shirts, pick up the second shirt. Now revenue is still at 5. Cost of goods now goes down to 3. Cost of goods will be increased to 3 because under LIFO, we take the last cost of production, which is at $3, and the gross profit will be lower, which is $2. Now we have the average cost method. Now under the average cost method, we simply find the average cost of each t-shirt. Okay, so we take everything, we just divide it into the numbers. Don't care what comes in last or first, which t-shirt the customer pays, which chair, the average cost will be calculated. Okay, so $2 per chair becomes you'll get at $2 per chair, which is 6 divided by 3. Okay. Revenue is still at 5. Cost of goods becomes $2. Okay. Gross profit remains 3. So when we compare all 3 methods, we will see the difference in flow. In terms of FIFO, revenue is 5. LIFO, revenue is 5. ABC revenue is 5. In case of cost of goods sold, FIFO will have the lowest, which is $1. LIFO the highest, second highest, $3, and average cost method at $2. Gross profit, however, FIFO will give you a higher gross profit. Okay, and LIFO lower, and average rate cost second highest. Now this means under FIFO you will pay the highest taxes and LIFO at the lowest. Now just see the put it in the ledger. Now FIFO method first in first out. Now November 1, $10 and 11, this is 110, and the balance here we have 20 at 10, 200, 10 at 11, 110. Okay, and we get 30 and 310. It's the balance. Okay, on November. Now let's assume that we're selling shares, and at the start of the month we have 20 units at the price of $10 each. And at November 1, we have additional purchase 10 shares at the price of $11 each. On November 3, let's say we have sold 15 units at $10. We assume that it's sold for the price of $10 each. Will give us a cost at 150. Now this will give us an ending inventory of RM5 units 10 and 10 units 11, bringing the inventory value at 160. Now, LIFO method, last in first out. Okay, same as before, but now under LIFO, the same ending stock the purchase, you can see the difference below. Okay, cost of goods sold is at $11. Using LIFO method, what we bought last will be the first to be sold, and 5 units at $10 each. Cost of goods cost of goods sold will be at 161. Now this will give us an inventory of 20 units at 10, bringing the inventory value at 150. Average cost method. Now average cost method is very simple. Okay, we first have to find the average cost per unit. To find that, we need to find the total cost, which is 20 times RM10 plus RM10 plus RM11, which is 200 plus 110 plus 310. You can see it here, and divide it by 30 units. Okay, so 30 units here divided by 310. This will give us an average cost of $10 per 33 per unit. Therefore, cost of goods for 15 units is RM15 will be 155. Now bringing the inventory at 155 as well.